Hi, welcome back. I'm still the same guy, and I have one of the great economists in the world who just counted down in my ear. You know, the TV team, you know, everyone's getting ready. We're going back to back. I just jammed a sandwich into myself so I could have something to eat in between sessions, and I hear 5, 4, 3, 2, 1. I thought you were counting down the Bank of England imploding. I didn't know what. First of all, welcome, my friend. Thank you for joining.
Thank you so much. Thank you, Keith. That's a great introduction, actually.
I mean, I couldn't believe it. I just said it with Liz Ann. I mean, it's like we took the cowbell, and then all of a sudden we said, no more cowbell after 3 days. Of all the things you've seen in central market planning and at the highest level, I think the Bank of England would be put at least in the top 3 in terms of age and experience. Would you characterize that as a panic or what?
It is a panic. It is certainly a panic, and it's a completely unwarranted panic, because the Bank of England knows perfectly that the reason why the yields of bonds are going up is because they artificially depress them for numerous years. And obviously, gravity works, and in bonds, gravity works the opposite way. Yields go up, prices go down. Now, the biggest problem is that the Bank of England, like the Bank of Japan, by the way, or the PBOC, decide to act aggressively now, and just today I read that they've bought all of the supply of gilts this this session. Yeah, all of it. So think about this: if the Bank of England is reacting that aggressively to something that would be categorized as absolutely normal in an environment of normalization of monetary policy, think about what they are going to be doing when inflation next year, instead of being 2%, as the models of Keynesian economists always show, next year 2%, is 4 or 5 or 6. No? So it's incredibly dangerous, because the signal that they're sending to the market is the following. First, we're not going to allow the sovereign bond yield to go above a certain level, and to do so, we will print all the money that is required. So, in essence, our objective is not price stability. Our objective is sovereign bond bubble. And with that, what they're basically saying is that the pound is not going to be a currency that is going to be globally demanded, because why would you? And it makes absolutely no sense from the perspective of anybody that follows the policy of the Bank of England to think that it's a good idea to bail out a few pension funds that have bought negative yielding bonds thinking they were the best thing after sliced bread, when the reality is that they were buying a bubble. But more importantly is that they're not bailing them out either. This is the problem. The problem is that everybody's talking about the intervention of the central bank, as if central banks did any other thing, by the way. But everybody's talking about the intervention of the Bank of England to save the gilts and the pension funds. No, it's not. No, it is not. It has created this problem. It's a problem created by policy, and it's not going to be solved by the same policy, but in an environment of inflation.
It's an amazing thing, and that is a very good description of what's going on, because a lot of people, it's new to them, right? Consider the alternative to what you just gave as an education. You're a meme stock guy, or you're like a tech investor, you know, you're US-centric FOMO. Like now you have to deal with the Bank of England, what UK T10 is doing in the morning. Oh, you thought that the CPI in the USA is the only thing that's ever going to matter for the rest of your life, now that it's been discounted for the last 9 months. And now you got to deal with UK bond yields, German 10-year yields breaking out this morning. Obviously we're talking about people who aren't playing, they're playing very siloed games within the game. You and I look at everything. How have the more accomplished, and I mean successful or not this year, a lot of performance numbers are all over the place. How have our peers been back and forth with you? How have they dealt with this this new regime of breakouts in bond yields? Just start with that. I mean, affecting equities, et cetera, et cetera.
Well, most people have been able to do nothing, to be fairly honest. And the reality is that for the vast majority of investment funds all over the world, they actually cannot do anything, because you have to be, on the one hand, fully invested. On the other hand, if you're conservative, you have to have 50% bond, 50% equities. Yep. So you're losing on both sides massively. It's the worst year since 1931 for the so-called winning strategy of 60% stocks, 40% bonds. You're basically living a tsunami on both sides. Mm-hmm. So everybody, this is what I find interesting. Everybody in surveys is saying that they're very bearish, that they're negative on the market, that they feel that the market is going to go down further. However, positioning hasn't changed significantly.
Right.
And that is and the reason is because there is no alternative to go. Most funds in the city simply cannot go into cash, even if they wanted to, or even if they envisioned this current situation. No, so basically, all that people are doing is trying to preserve capital. And to try to get some form of view of whether the earnings outlook of the stocks that they own and the solvency ratios of the bonds that they owned are getting better or worse. I think that, but positioning-wise, I think that that there's been very few changes. And you can actually tell by the fund flows into equities in the United States or in the European Union, and the fund flows, for example, into gold or precious metals, which have been negative.
Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there, subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content. Liz Ann Sonders also made this point. Generationally, it's just the opposite of what people. She reminded me that I would never guess this, but she says she's older than me. But you and I, let's just take you and I, because our experience was initially like we were buy-siders. You were at Citadel, I was at Magnetar. We've dealt with this environment where you could run a lot of gross leverage, and a lot of people ran, not Citadel, but a lot of people still ran with a lot of net long leverage. But the gross leverage that people were running really, imply that at some point the Fed's there with the carry trade, that you do Absolutely. Get the down bond yields and I can have the other side of the book on. That's gone. Yeah. That is completely gone. And I've never seen, like, if you're trying to run neutral on that when there's no neutrality whatsoever. I mean, utilities are down 17% in the last month in the USA. REITs are down 18%. That's not neutral to rates.
Exactly. This is the problem. Is the problem of 2022 is what made everyone get excessively optimistic and excessively bullish in 2020 is that we're living the boomerang effect of a massive carry trade against the US dollar. So that's why there's nowhere to hide in this environment. And you've mentioned two things that are very important. We got into 2022 with a level of net long exposure at hedge funds that ran around 40%, according to HSBC. Now, 40% net long. That is massive. The second thing, so everybody was already saying this was going to be a phenomenal year anyway. The second thing is where that length was. That length was fundamentally in things that were fashionable. ESG, the most cyclical, the most tech oriented stocks, and then leverage at a gross level. Because we all know that if you want to reduce risk when everything is imploding, you need to reduce gross, and you need to reduce quickly.
Right.
But right now, the situation is you reduce gross. For example, if you're in a market neutral or in a hedge fund that allows you to be 40% net long, who would have thought in our times, by the way? But if you reduce gross, that capital needs to go somewhere else. And that capital needs to go somewhere that is currently not very happy about any other place to put money into. No, it's not easy. It's not easy.
No, it's real hard.
So those that find ourselves in the situation in which you have to be 100% invested every day, the only thing that we can truly do is damage control, and that's basically our policy. No.
Yeah, that's brutal. I mean, and again, said by nobody ever that you couldn't run net short. That's the whole point, like, of running a hedge fund. I mean, again, I get the institutionalization of the business. We understand that a lot of the motherships are in the business of collecting that fee, and the portfolio managers, they're kind of indifferent on who sits, in each cockpit. If you suck, you get tapped. You bring in the new person. So I get the marketing of running neutral. I get the marketing of running, Tiger Cub style with massive gross and net long leverage. But said by nobody, entering a recession, can you run that way? I mean, I've been running between +5 net long, +5 with no gross long leverage, and -25% net short. That's what I do in a bear market. That's what I'll do until I get a little braver. But for me, that works. I was looking at the Goldman Prime brokerage data this weekend, Danielle. The average, and it's fundamental long short, so it's different because obviously if you put in all the CTAs and all the all the rules-based strategies that are actually, a lot of them are actually doing okay. It was 44% net long coming into last week's decline. I mean, are you kidding me? Now on that, this is what I wanted to jump off of. Every single, I shouldn't say every single client. We do have clients that are crushing it this year. There are some hedge funds that have run net short. There are some clients that are putting up some great numbers. But even those guys live in unbelievable existential fear of the next Fed pivot, okay? Yeah. So, because that's where their shorts get squeezed, and that's where the glory and the dream comes back. Now, you just wrote, and I couldn't, this is a great title for this. So, Daniel Lacalle just wrote a note that said, Fed pivot is not an investment thesis. Now, so you wrote in bold letters, what if I could say at the start of every institutional client call would trigger and upset the clients and maybe have them fire me. Thank you for writing that, okay? You said it is not even a thesis. Can you expand on that?
Well, to start with, no investor should be positioning their portfolio on the basis of what the central bank will or will not do. But even less so when you know that the central bank has implemented a strategy that they perceived to be dovish, that they perceived to be prudent, that they perceived to be adequate for markets, and the market is tanking with it. So it's very dangerous to believe that everything will be solved by the Fed pivoting when the Fed has already pivoted. Because the Fed is every day undertaking the reverse repo filling up that they undertake every day. The Fed is already raising rates at a level that is completely in line with what they had said, and they're actually not increasing that pace in an environment of much higher inflation than when they announced that pace. This is important. So that's already a pivot.
Yeah.
See, the fact that the Fed is hiking rates at the pace that they had when inflation was 4% is the same as the pace that they said it was going to be 4%, is the same when inflation is at 8.5%, 9%. My friends, that is already a pivot. And that is already showing that you need, and also, if your thesis is a central bank-led market boom, you need a lot more than pivoting on rate hikes, because the market does not expand multiples simply on rate increases or rate cuts, but it needs massive higher liquidity injections, i.e. quantitative easing, not tightening. So the fact that there would be no change in the balance sheet of the Federal Reserve and stopping the rate hikes may stop the bleeding, may reduce the pace of the bleeding, but it's certainly not a bullish argument to buy anything, and more importantly, not a reason to buy anything that has gone down a lot simply because it's gone down a lot without paying attention to earnings or to the macro environment.
This is the macro show. This is pregame, okay? We're trying to play the game that's in front of us today, trying to give you all the content so that you can see that there are many tools in the toolbox to play at the highest level. You know, leadership matters at Hedgeye, so again, being transparent, accountable, and trustworthy people. This is a game about playing and weighing probability. It's not about picking stocks. It's about picking the right portfolio. Execute across everything. Don't get distracted by the MSM and the tourists. They're very dangerous. I will grind and execute for you with our people and with you.
Yeah, that in a picture, just so you can summarize on slide 44, we're showing, we call it pivot hopium, but again, just showing Fed fund futures going from now through 2023 into 2024. Essentially, and correct me if I'm wrong, what you're saying is the pivot is where I have that, we've already pivoted. In other words, they're done with the rate hikes starting in the first quarter. I think February is considered the last hike, but they don't have the rate cuts.
Exactly. Exactly.
Like every bear market rally that we've had that became a bull market came out of the bottom of an economic slowdown where the Fed was actually cutting rates. And even in 2008, you couldn't cut rates any faster. Greenspan, 2001, you couldn't be, I guess you could have been more aggressive. You could have been like Bernanke and won a Nobel Prize for that. But the fact of the matter is that they're cutting rates and stocks kept going down.
That is important because you need to see the bottom of the economic cycle. We're seeing the slowdown of the economic cycle. We're seeing a very painful slowdown because the downgrades in economic growth and the upgrades on midterm inflation expectations are slow. It would be much better for a market rally to actually had seen a significant downturn in the first half of the year and then some form of recovery. But the problem, this is the problem of the risk of stagflation, is that the risk of stagflation is incredibly bad for stocks on an ETF perspective, in an index type of way, which is where most investors have found comfort in running the beta wave. No, so it's very bad because it is precisely the multi-mega caps that do horribly wrong, horribly bad. They do very badly, and also because it does not generate the type of change in monetary policy that would make markets get exuberant again. So what you may actually find is that precisely because the macro data points are not as atrocious as a massive crisis, that the policy of central banks is going to remain, as I said before, accommodative in the sense that they're already not hiking rates much faster than what they said, but not the level of expansionary monetary policy that markets require. And remember what type of market we're living, because the European Union, the European Central Bank, recently published the monetary aggregates of the ECB. The money supply growth in the Eurozone is growing faster than it was when we called it the bazooka Draghi. Okay?
Yeah.
So what is it that markets are looking for? What markets are looking for is not accommodative or loose monetary policy. They're looking for extraordinarily loose policy that is more similar to the insanity of 2020 than the similar but significantly lower insanity of 2014.
It's amazing. I mean, you even had Cathie Wood write a paper on it, I guess, the other day. It's like, bring back my fund. Yeah, come to me. I need those conditions. You're never going to get those conditions again unless we're coming out of World War III. By the way, I wouldn't rule that out coming out of it.
Yeah.
We may be going into it, but I'm not. That's not a macro call or anything like that. What you just did, which is it's kind of interesting, with Liz Ann Sonders, I made it 18 minutes without talking about inflation. With Daniel Lacaille, the world's best economist, strategist in Europe, I made it 20 without talking about Europe. Okay, now on Europe, and you also said you tied it to the, like only you can, you tied it to the mega caps and the ETFs. On the FANG, 51% of revenues come from international, 25% from Europe. So if you think that you can just solve for this trading tomorrow's CPI, or you know what Fed pivot you're looking for, and you're completely blind to how long and protracted a European recession can be, where are you? I mean, I don't know. Could this be? I often wonder, am I bearish enough on Europe, both equity and just the depth and the length of a possible recession? What do you think?
Yeah. Well, I don't think we are bearish enough, because the estimates that we see out there are incredibly optimistic.
Yeah.
The entire thesis about Europe and the macro environment in Europe is predicated on the idea that this is a winter problem, and that as soon as the sun rises again and it's warmer, it's actually still warm, everything will be okay.
Are they talking about being 30 years old again in Ibiza, or are they talking about the actual cycle?
I think, I don't even think that they're looking at the 30-year. I think that it's a fantasy, not even what they lived in Ibiza, which was probably being sunburnt and listening to too much techno. But the real problem in the Eurozone starts earlier. Okay, if you remember, actually, we had this discussion. Remember, in the middle of the COVID estimates and everybody coming with the new stimulus packages, etc., all of the international entities had estimates that showed that the Eurozone was going to come out of the COVID-19 crisis faster and better than the United States, the UK, Japan, than everybody else. Okay, so there was this huge level of complacency about the stimulus plan in the Eurozone. Well, in reality, what happened, we discussed, you and I actually a few times, was the opposite, was that the Eurozone yet again came out weaker, with more debt, with less employment growth, and that sets the backdrop for the current crisis. So it's already coming from a slower growth, slower and more indebted level of growth, and a worse in terms of productivity growth situation. Okay. Second, the energy problem in the Eurozone is not just a problem of the Ukraine crisis. It is a problem that comes back many years prior, when the politicians decided that the best way to develop an economy was to have very expensive energy and incredibly taxed industries. So the problem of high energy prices was already evident before the Ukraine crisis, and the move of industries outside of the Eurozone was already pretty evident, but now it's going to get worse. And the reason why it's going to get worse is because people are making assumptions about a recovery based on the end of winter without taking into account the fact that we have yet to see the real implications of the energy crisis, because most households and businesses are seeing their bills rocket, yes, but they have not been adjusted to the new contracts that are being negotiated now. So that is a big problem. We're going to start to see businesses closing, unemployment rising, and certainly a much weaker level of growth.
Now that, again, like an education that can be provided to people without a commercial or some person interrupting you. I'm not going to name channels where you have the patience, by the way, my friend, of Job. If you look at this within the lens of the currency market, so again, tying it all back to dollars in debt and the amounts of debts in dollars, and just understand that the euro is the most important part of that puzzle to solve for if you're looking at the US dollar index. On slide 48, if you could just comment on this. So if we're just getting started fighting inflation in the USA, and you are Paul Volcker, we've only had the beginning of that move that started obviously coming out of the late 1970s. We've only had the first part. The problem with this question is that the euro didn't exist. If you go to the next part where I have a circle, where again, and everybody can see that, you know, entering the 1980 recession, entering the 2000-2001 recession, that's the whole point about Quad 4. Global Quad 4 is worse because your currency goes down and people go to US cash, but you're going to have a pervasively strong dollar. Now, in the future state, you already said what you think about the pound, which, by the way, isn't an inconsequential part of the basket. So we're going to say that's going to hell in a handbasket, or I think that's what you said. Now, how low can the euro go, and will they actually turn tail dovish in the way that U.S. investors hope the Fed does, and actually go back to printing money?
It's much more likely that the ECB pivots the way that investors would like the Fed to pivot than the Fed do it.
You think
Why?
so? That, I wish more people would just say that quickly and assume that. I mean, but do you want to go buy an Austrian stock this morning if I tell you that they're going to do that tomorrow? In America, no. It's Europe. That means it's shit's hitting the fan. Oh, but if they do it in the U.S., it's okay, right?
Yeah. Exactly. So you have so if you want to be betting against the U.S. dollar, you have a very big problem with fundamentals right now. The first is that out of the $90 trillion of global money supply, liquidity, how you want to call it, that exists out there, around 10% is a massive negative bet on the US dollar predicated on the 2020 stimulus plans. On the DXY is fundamentally the yen and the euro.
Yep.
And none of those two central banks are working in your favor if you want to bet against the DXY. None of them. Not either the ECB or the Bank of Japan. The Bank of Japan is not defending the yen. The Bank of Japan is slowing down the pace of depreciation of the yen, which is not the same thing. So the problem I have is that in the European Central Bank, simply mathematics will not help you if you want to go long the euro for a long period of time. There might be small blips, no? For a very simple reason. The monster new generation package that was implemented by the Eurozone and that is basically more printed money, that kicks in fundamentally between 2022 and 2023. So that is more support from the European Central Bank. Second, the European Central Bank's anti-fragmentation tool is, in essence, a tool to not reduce the balance sheet. You basically just every time that a German or Dutch bond is matured, you basically buy Italian or Spanish bonds, which is a great idea if you want to have a very non-toxic. Sorry, just a call that entered. So the problem that I find is that you don't have any type of real incentive from the European Central Bank or the Bank of Japan to truly defend the currency. And that fund flows don't help either, because the euro was supported by a massive trade surplus. That trade surplus has all but gone now because of the energy crisis. But hold on a second, it's not just because of the energy crisis, it's the Chinese slowdown as well. So you may have a situation in which the imports of natural gas may come down a little bit, but you still don't have the support of the exports to China. So if you put it all together, basically, it's going to be extremely difficult to make the dollar go to where people want it to go, which is literally based on only what they want, not on any piece of data. You're not supported by the amount of maturing dollar-denominated debt. You're not supported by the actions of central banks that have actually reduced their holdings of dollars and now need to purchase more dollars. You're not supported by the trade surplus of the European Union. You're certainly not supported by the actions of the UK Central Bank or the Bank of Japan. So something that we discussed a few times together, the 17 trillion deficit of US dollars in the economy, has actually gone up, not down. So I find it extremely difficult to believe that you can bet on the US dollar weakening relative to those currencies, because we're talking, it's all a relative game. The only way in which you can do that is if you truly believe that the Fed is not going to pivot on hiking rates, but is going to start quantitative easing. And if the economy is in stagnation, not in massive crisis, then that is not going to happen.
Well, on the just to finish that off, and then I want to take some questions. If you have, we have a lot of questions in the queue. Fire away, and we'll pick the ones that have the highest votes. The credit side of the trade in Europe, like if you look at slide 60, even again, this is not to simplify the complex too much, but there are two red circles there. One, of course, people think will never happen again, which is during the banking crisis of 2008, and then there's the European crisis again in 2011. But we're just getting started on a breakout on the credit side. You made the point on the household side. You said, look, still early days because your energy and utility bills are just about to reset at the next cost. How about the cost of capital, and how about that picture relative to the prior cycles? Do you think that that's going to sustainably stay high and wide and widening, or not? And let's just start with that.
Yeah, I certainly think it has to. But more importantly, the reason why it has to is because all of these enormous loans that the different countries gave in 2020, 2021, they are maturing now. And many of those banks are going from having a loan that was partially subsidized or fully subsidized by the government to renegotiate those loans in normal environment of credit and solvency terms. So those costs are going up, and they're going up massively. For example, the average loan provided to business in order to survive the COVID-19 crisis was at around 2.5% to 3%. Okay, for a year and a half, maybe 2 years. Okay, those are being renegotiated at 6.5%, 7%, 7.5%. A lot of those companies are simply unable to pay those loans or even renegotiate those loans. So even with banks being fundamentally dovish and open in an environment in which credit supply is ample, the reality is that a lot of businesses are going to go bust on the combination of higher costs plus the higher financing costs. So those credit spreads can only go up in an environment in which the European Central Bank, at least until March next year, is going to continue to hike rates. Because at the same time, right, in the United States, we have producer prices at 8.5, but in the European Union, you have countries in which producer prices are up 40%. It's not just, it's not just a small difference. Okay, so the biggest problem here is that the banking system in the European Union has significantly improved from where it was in 2013, 2014, no doubt about it. However, it continues to be significantly more exposed to non-performing loans than, obviously, the United States ones. So that is certainly going to at least continue to rise into the first quarter of 2023, in my opinion.
Yeah, this is that's the corporate side. You hit on the household side. The household side, I mean, some of the charts that we show people, if they're not, I mean, a lot of, again, there's a U.S. centricity to the bubble, I think, where people just don't get it. Like, because to your point, the huge difference in PPI alone, relatively speaking, I think we have that in our current slide deck so people can see it. But if you look at slide 63, this is the energy spike, in context. I mean, that thing looks like dead man walking, and all of a sudden it's volatility central, much higher prices. But if you think about all this and you think about CDS, like Josh Steiner made this very good point, who's becoming a fantastic macro strategist on his own right this year, and has put in a lot of great work for us. He's like, Keith, like, these are country CDS. 5-year CDS, I think most macro strategists, that should be like, just like where are the futures, that should be on your screen. Look at this slide 68. And it was kind of a joke when we first put it up that, go to the next slide, guys, slide 69, where I showed Polish CDS. Can you see that, Daniel? You obviously know where these are, but Like,
Yeah,
okay,
yeah.
Polish CDS. Who cares about Poland? They're near the Ukraine. That's what that is. No, I mean, go back at even in 2016 what CDS can do in Europe. I mean, so
Yeah.
alongside that we have what hasn't moved but is now moving, which includes places like the UK and Austria. Finland's in there as well. What do you do you think that could just go on and on and on?
Oh, it can go on for a while. It doesn't go on forever, obviously.
No, not forever, but I mean,
but
ECB
the
would have to
point-
intervene.
The ECB would have to intervene. And the reason why the ECB would have to intervene is that, unlike other crises prior to this one, what we are seeing is, for the first time, at least that I can remember, for the first time, an environment in which governments are seeing their bond yields relative to the German bond going higher are not reducing their expenditure or reducing their deficits, but increasing them. So the issue that we find in this particular recession is that even if the ECB intervenes with the tools that they have announced, it would not be enough. It would not be enough simply because governments are unwilling to reduce the annual deficit. And obviously in 2022, it looks very rosy because governments are collecting a completely insane amount of tax revenues from inflation. As you know, in Europe, taxes are not deflated. So the deficits look okay. But when you add governments that are increasing expenditure and getting accustomed to extraordinary receipts that don't reduce their expenditures, and in 2023 then the crisis or the recession really hits harder, then the problem of deficit rises to its full extent. So what I'm worried about is actually that even if the ECB intervenes, it cannot do two things at the same time. No, it cannot at the same time hike rates and try to curb inflation while keeping the bond yields low. So it has to choose. And unfortunately for those who believe that the European Central Bank is not going to increase rates, that is not likely to be seen by market participants well into the first quarter of 2023.
Yeah, I mean, you can see that this morning, guys. You can show the DET 10-year chart, UK 10-year chart. You could toggle back and forth. You could say, well, the UK 10-year is doing one because the Bank of England's panicking. Well, no, they're the same chart. I mean, the German 10,
the same chart.
They just broke out to new cycle highs. I mean, and every Tom, Dick, and Harry in the USA is trying to debate if the 10-year yield can get above 4 and stay there, which would be a new cycle high. So it's just an interesting time on so many levels and unprecedented times. And I guess, like my summary on all this with Lizanne Saunders was the same. My job is to get the direction right, not to tell you like what is the German 10-year yield going to peak at this basis point. That's a fool's game. I mean, it's just going higher. It's crazy.
It is going high, but again, people are ignoring currency and people are ignoring the economic cycle. The economic cycle, the inflationary cycle, and the currency are not supporting yields coming down anytime soon.
Right. Yeah, people don't. I mean, it's simple math too. I mean, it's like the reason why you have 45% producer prices in a certain country in Europe is because their costs are in euros. I mean, there's the dollar's strong. You take that, turn it upside down, and you get closer to the point. I want to get some of these questions because people are gonna ask a lot of good ones. And the first one's from Tim in St. Louis. Daniel.
Yeah.
Will the war in Ukraine be the strain that leads to the breakup of the EU and the euro?
No. And this is something that I just came from Arizona. I had this question over and over again, and it's no, it won't. And the reason why it won't is because the Eurozone right now is in a situation in which no country, even Italy, that just had elections with a government that can be perceived as a Eurosceptic, etc. And the reason why is simply because there's no alternative. Okay, there's no alternative to the euro. Italians don't want the lira. Greek citizens don't want the drachma. Think about this for a second. When we look at it from the U.S. perspective or from a market perspective, we think that the euro is a disaster, that it's down as much as the pound and the yen against the dollar, etc. And all of that is correct. Think for a second, what kind of inflation would Italy or Germany or Spain or Portugal have if they weren't in the euro?
Yeah,
Think about it for a second.
You don't have, would be if you look like Sri Lanka,
Argentina style, my friend, Argentina style. On top of it, in Spain, they have an Argentina style government. So why not go full Buenos Aires? So that is precisely the reason, is that although we see it from the glass half empty, which is not a bad way of looking at it, if you look at it inside the Eurozone, you say, hold on a second. How much would my real wages be down if because this is the Eurozone is an economic area of very aged people that have actually seen other currencies, and they know they know they know because this says a lot about my age as well, is that the first mortgage I had when I got out of university in Spain was at 14%. Why was that? Because inflation was at 16.
It's an interesting thing. People, obviously, it's a good question. You have an answer.
Very quick.
And I do love the attempts of simplification, because trying to simplify the complex is what most people on Wall Street, correct me if I'm wrong, want a simple answer so they don't have to do as much work. I mean, you have to do. Daniel Lacalle wakes up every day just like Lisanne Saunders. You can follow him on Twitter. The guy is a grinder. He goes through every single thing, every single thing that matters in rate of change terms in the European economy and the U.S. economy. He's a wrecking ball. And then he can say, with all of his experience, no to that question, right? Whereas you got a lot of macro tourists, they're just like, they got the most dangerous thing, obviously, is having an opinion about everything and experience on nothing. But I just think that there are a lot of opinions out there in macro space. Maybe it's just the echo chamber that is Twitter. But here's the next question here. This is an interesting one. We haven't had one on the World Economic Forum in a while. Leon Lobos, can you please, Daniel, can you please discuss the influence of the World Economic Forum on the fiscal and monetary actions of European governments and central banks? Thanks.
This is a very good question as well. Very, very, very relevant. Certainly, the change of narrative is clearly driven by not just the World Economic Forum, but the shift of IMF and other international bodies that have incorrectly placed the so-called austerity as the problem of the previous crisis. So if you look at the overall message that we get from many of these international bodies is basically, okay, governments need to spend in order to sort out the problem, which comes as some sort of trying to make it better, considering that they perceived that it was so-called austerity would generate the previous crisis problem, instead of monetary and fiscal excess, which generates a much worse downturn. Fiscal policy and monetary policy don't prevent crisis; they just move it forward a little bit, and usually they make it worse because in the meantime they incentivize massive increases in debt. But certainly there is a so-called neo-Keynesian rhetoric embedded in many of these international bodies that think that the old solutions of spending like there's no tomorrow and even increasing intervention are going to help in any shape or form. But yes, it is the case. But in any case, governments always do the same thing. When you have an international body that says that they have to cut taxes and cut the pension system, they don't listen. And when that same international body tells them to increase taxes, they say, yes, they're the first. So they pick and choose the things that the World Economic Forum or the IMF recommend, and then they obviously do whatever they want, which is what governments always do.
So you're saying they're not going to call it the World Economic Forum of Hayek and von Mises anytime soon?
No. Well, that wasn't going to happen either, prior.
Well, this last, we have time for one more question here. I get asked this question. It's kind of a joke to ask me the question because the probability is zero for me. I get asked, oh, okay, well, then what if you were head of the Fed, what would you do? But with you're getting to be a little too accomplished there, my dear sir. So they might ask you to take a crack at it. Give me a buzz if they do. I'd love to hear your thoughts on risk managing the decision. But Rich asked the question, Daniel, if you were put in charge of the ECB, what would be your first order of business to fix Europe?
Well, just first to start with, if you're the head of the ECB, your business is not to fix Europe. But this is a critical thing because we tend to forget what the mandate is. The mandate of the ECB is price stability. Everything else is fiscal policy. Even Bernanke said this about monetary policy when he was at the Fed. He said, we're not here to reduce inequality. We're not here to make decisions on fiscal policy. We're here for price stability. And then they added the unemployment thing, but well, who cares? The point is the ECB's mandate is price stability. Price stability is defined, and don't ask me why, at 2% per annum in the long term. Okay, so 2% per annum. The ECB therefore is massively behind its mandate. So what it needs to do is three things, and those three things are very complicated. The first thing is obviously to hike rates. The second thing is to reduce the balance sheet of the bank, not to keep it. People are talking about normalization, doing nothing with the balance sheet. You need to reduce it. The third thing that they need to do is the tools that they have, anti-fragmentation tool, the different programs of repurchases, etc., they cannot be implemented as programs that are a perverse incentive that incentivizes countries that do the wrong thing to continue to do the wrong thing with the money of the countries that do things correctly. Okay, so you need to change that. You cannot provide more liquidity and more support to a country that is increasing the structural deficit and increasing spending at the expense of those that don't. You need to change that. So those three things need to happen. Obviously, as I'm not going to be appointed, and in any case, even if I was, it would be voted among all of the other members. It's a fun discussion to have.
Well, I mean, it's one thing to be critical; it's another thing to have a solution, right? So there's.
I think but to be fairly honest, the solution of the Eurozone is. The solution of the Eurozone is to create a system in which the support of the central bank is not provided by giving more to those that do things incorrectly and giving less to those that are doing things incorrectly. It has to be changed the other way around. It has to be there has to be a system of also some form of penalization if the targets are not met.
Yeah, you've been very consistent with that over the years. And for those of you that have not read any of Daniel Lacaille's books, he's written many at this point, and you can really get a good, fine appreciation of his framework and how he thinks about this in central planning, central market planning, central banking, the ECB, the Fed, fully loaded. You gave everyone, in particular people that may not pay as much attention to Europe, quite an education here, so thank you.
Thank you very much. It's been, as always, a pleasure. Also good.
Always good to see you, my friend. Always good to see him. So we go from the Spanish guy to the Irish guy. Brendan Ahern's next.
Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there, subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.